Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Giantomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knakal Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Sterling & Sterling, Urban American, The Wickoff Group.
So what's happening in 2011? Investment sales going to do well? Property's going to sell for a lot of money? Who knows? I really don't know. And my little apple over here doesn't know either. So today I've assembled some individuals who allegedly, and you hear what I'm saying, allegedly, are the real people who know what's happening in investment sales. And they're going to provide their insight on what's happening in the investment sales market. My guests today include Woody Heller, the Senior Executive Managing Director and Head of the Capital Transactions Group at Studley. David Lebenstein, who is the Senior Managing Director at Cassidy and Turley. Alan Miller, who is the Senior Director and Principal at Eastern Consolidated. And last but not least, my executive producer for today's show, the man who controlled the apple by helping me bring these people together, Bob Knakal, who's the chairman of Massey Knakal, and also known as the statistician. Why do I call him the statistician? Because tell us what's really happening. Oh, great statistician.
Well, Michael, you know that I like statistics more than adjectives when I talk about the market, so then everybody can draw their own conclusion as to what's going on. But I think the investment sales market clearly is on the upswing. We always talk about the two V's, value and volume. It's very clear that volume is up significantly. We had about $6.3 billion in sales volume in New York in 2009. That went up to $14.5 billion last year. That's a 131% increase. Unfortunately, the number of buildings sold only increased by 16%. So what we've seen is
we only
larger
buildings?
transactions.
I mean, Woody sold a nice little piece of land last year at a nice price.
Well, properties, not just buildings. I referred to it last year. About 1,600 properties sold in the city. That was up just 16%. So we've seen definitely more larger transactions occurring.
So shinier?
Well, things are good. Unfortunately, that's the volume side definitely is on the upswing, and it's very clear that the bottom of the market was the second quarter of 2009. With respect to value, we think that we saw value drop on a price per square foot basis in 2010 versus 2009, but the rate of decline throughout the year slowed. So we believe that a year from now we're going to look back at the market and identify either the third or fourth quarter of 2010 as the point at which value changed and we finally started to see some appreciation.
So now when I speak a little English, I will say what happens, I'm going to ask Woody or I'm going to ask David or I'm going to ask Alan, what happens if interest rates go up? Woody?
Oh, I think that's a question you should definitely ask Bob.
Woody?
Interest rates are an extremely important component of the equation. There's no question about it. And I think that to a certain extent, or to a large extent, the pricing appreciation that we're certainly seeing in my segment of the market has been contributed to by interest rates.
Would you explain to my audience what is your segment as compared to the three other gentlemen sitting in this room?
Yes, but that might reflect a certain bias. I think it's better if you delineate that for us.
Oh, that means that the property must be in the borough of Manhattan.
That would be one delineation of relevance. Thank you very much.
Class A and better properties?
You know, to some extent, sometimes we think about it in terms of the size of the transaction.
Okay. So you're looking at higher transactions. So higher price transactions, interest rates is definitely very sensitive.
I think all transactions are extremely sensitive to interest rates. So will increasing interest rates have a negative impact on the marketplace? Of course it will. The question is the extent to which will impact it and the timing of that change. You know, Bob has an opinion about when that will occur. There's a lot of economists that think that it's not going to happen imminently, but of course no one expects interest rates to be going down. So I think when you look into the market going forward, the expectation is fundamentals are getting better. I'm speaking about Manhattan office rents. The expectation is we're all questioning is what the shape of the curve will be, but the expectation is they're going to go up. So fundamentals are getting better. Allocations from a capital market perspective are already very high. Cap rates are already pretty low and fell back down to a remarkably low level rather quickly after the market's adjustment. So so if you're looking forward and wondering, so what could go wrong? I think the thing that we most have concern about is the rise in interest rates. And I think it's a very different situation if interest rates go up 100 basis points or 300 basis points.
But we were saying before, Bob, interest rates on multifamily at the end of last year were 4%. And I told you that they're close to 4 3/4. That effect is going to have an effect on the sale of you and the multifamily.
Yeah, Michael, clearly interest rates are exerting upward pressure on lending rates. Like you say, we've seen the 10-year increase by almost 100 basis points since its low point. As interest rates rise, lending rates will rise. As lending rates rise, we're going to see an upward pressure on cap rates, and that will exert negative pressure on value. And I think rates are going to rise quicker than people think because of what's happened with the money supply and what the Fed's balance sheet having tripled in the past 2 years. When the Fed exits the market, they have only 4 ways to do that, all of which will exert significant upward pressure on interest rates. I think it's one of the things that is of most concern looking forward.
So, Alan, I really want to ask you and also say, father of AJ and father of A. Ray, because we know the family well, how do you see people, who's out there looking to buy? You were saying to me that they're foreign investors. Who are the buyers today?
Most of the work that we do or our company is in the metropolitan area. I'd say 90% Manhattan. Yes, we do stuff in the boroughs, a lot. But
Thank God I have some other people. I mean, Woody doesn't even know. His shoe has a detection like the old Get Smart that if he leaves Manhattan, it goes beep, 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 beep. He's not allowed to be around.
But I think that there's a lot of still, there always are new entrants to the market, both domestic and foreign. I know I've seen Bob speak a lot, and our experiences with these new first-time buyers to Manhattan from a lot of different countries. What was amazing to me is the people that were sitting on the sidelines, some of these generational families that just got into the game, and the prices really never fell.
That's a great point. As you said, you sold the property at the end of the year, and a generational family who hadn't bought in years bought the property. Why'd they go into the market last year?
It's still mystifying to me, but you're referring to the property we sold for Stonehenge Partners, which almost didn't get executed. It's a deal that I worked on all last year. I think the conversation started in January. We hit the market with this income-producing multi-family building, which is probably the best investment long-term. It's always rental buildings in Manhattan and its environs, but we hit the market with no asking price, no formal advertising. It's a great asset. It was 95 apartments, a couple of restaurants, and a small garage. But without an asking price at the beginning of the process, it was a tough situation. Seller wasn't so easy because the sellers at the outset of that marketing campaign wouldn't sell for what the market would bear at that time. You know, Stonehenge Partners, this is the third asset I think that Ofer and Joel had bought back in 1995, and they just, you know, not easy sellers, and not many sellers are easy, but their rationale was that if we can't buy an elevated building in Manhattan for a 5 cap, why should we sell for a 5 cap? So we embarked on this campaign, worked really hard. Almost, I guess during the summer, they wanted to conclude a deal. We couldn't quite get to the expectations what the sellers wanted. I mean, the market was expressing itself like it usually does. You want to work with sellers that are selling into the market. It is Manhattan. It's a rare product because there really aren't that many corner, substantially sized elevated buildings available at any one time. And there was only a few that sold in Manhattan. So at the end, we found this generational family. They'd been in business for 67 years. They just fly below the radar. And I guess they had a decision they had made is it was the right time to stop buying. That asset generated a lot of interest. A lot of people came into the same range. In fact, the sellers didn't really want to show the property unless everyone was at a certain level before they went in. And we wound up inspecting it with about 20 groups. That was getting towards the end of the year. One of the reasons, one of the impetuses to Stonehenge wanting to sell it because they were raising a fund. They needed equity to put into a fund, and they had a lot of equity in this building. They had foreclosed actually in the Sal Goldman estate back in 1995. He had died, and his widow lost the building. There was a rent strike at the time. 1995, this property on 56th Street, 9th Avenue. It was much different.
Okay.
And at the end of the day,
I got the idea. So, David, you have a little different specialty. You represent a lot of nonprofits selling buildings. Are they, since Bob, and I hear from Woody, and I hear from Alan, you know, there are a lot of purchasers are out there. How are they doing on the sale of their profit, of their buildings?
Well, I said to Bob before, because he's the guru on these kind of sales, it's a lot easier to sell these buildings than it is to find the place to relocate. None of these groups can sell unless they have a place to go, and that's one of the challenges. So all of them are doing analyses of buy versus lease. Should I be leasing space, or should I buy another space? And that's part of the challenge.
So some part of that also is a situation that certain nonprofits, and I remember writing articles and being preaching this subject and practicing it because I was involved with nonprofits. Nonprofits didn't really need to be in fancy townhouses.
Well, that's true.
You know, they could be in an office building where they could buy an office condominium, because if they buy an office condominium, they don't have to pay the real estate taxes, which gives them that same benefit.
I think in most cases they don't belong in townhouses. They're very inefficient. There's small footprints and small floor plates. So I often advocate for them to move to one-floor commercial condo.
Here's a good question. How hard is it, you know, like Alan was saying about Stonehenge, they had this price expectation of where they want. When you have a nonprofit, how difficult is it to get that board on there to make a decision to sell the property?
It's very challenging, and there are a lot of different opinions, and part of our job as capable brokers is to help people reach consensus and test the market and see what's out there. But like I said, like we recently teamed up with Massey Knakal on a situation where we would relocate the tenant and Massey would sell the building. Well, the relocation is really challenging because where are they going to go? And most of these groups don't want to lease. They want to own. They don't pay real estate taxes if they own. They have a capital campaign and fundraising vehicle if they own, and they control their destiny. They're not going to be pushed around. If they use a drug treatment agency or something, they don't have to worry about a landlord not wanting their use there.
But you know, you bring out an interesting point. Woody, you know, when Google bought 111 8th Avenue, part of it is relating to the fact that Google likes owning property. And the second subject was the accounting rules on the capitalization of leases. Do you see more companies buying buildings?
I absolutely do. I mean, I think what will happen to the accounting rules is yet to be determined. The code hasn't been finalized, but I think the expectation is that change is coming, and whatever the details are, It's going to change it so that the delineation or the distinction between owning versus leasing goes away, and therefore it's important. I'm sorry, it becomes very important to own.
Which is very interesting because you remember going back when companies like Verizon and other people in Con Ed were in the position of they all wanted to get rid of the assets because they didn't, so
And they're still doing it.
so there's a situation over there.
Right.
What
But
about
that's a different issue in terms of motivation.
Right, there's
but
different
it's all balance sheet related.
What about, we were talking, you sold the Drake site, probably, in my opinion, the best development site in Manhattan today. What about other development sites being sold, and who are they being sold to? Who, are they being sold to rental or condos? What are you seeing?
Well, I think that's been a very dynamic change in the marketplace because development sites really, there were very few comps of sites that sold for the last several years. So one of the changes that we've observed is the number of sites that are suddenly being brought to market for sale, and that reflects the market's attitude towards buying them, which is to say that in the '09 period, most of the few sites that sold, most of them were bought, as Bob and I were saying before, were sold to users. And those users paid relatively high prices, but those are exceptional cases for all the reasons David mentions, that it's very hard to find new homes for places that want to occupy specifically. But for developers that were buying land on spec, that was much more challenging. It was virtually impossible to get acquisition loan financing, and it was certainly impossible at that time to get construction loan financing. What's changed in the market today is a number of things. Number one, investors/developers are now back in the market buying land. Number two, they're buying it and underwriting it on the basis of building condos, not building rentals, which means that they can pay a higher price for it. And number three, a lot of this is occurring because of the expectation now that given the fact that the financing markets have become more active, that you can both get an acquisition loan and you will soon be able to get a construction loan.
You can get a construction loan if you're a well-capitalized borrower
And you
with a
don't
lot
need
of
the money.
equity, and if you don't need the money, you're very right. But Bob, we've been talking around, you write articles about it, I talk about it, and the other subject about debt. There's a lot of debt coming to the market because there's a lot of CMBS over there. I know Allen Shop is doing a lot of sales of debt. What are you seeing in the distressed debt, and what is it selling for?
Well, that's a great question. And when I talked about the activity in the market, I think that the psychology of participants in the market is a lot healthier than demonstrated by the $14.5 billion in sales last year, because on top of that, we think there were about $6 to $7 billion in note sale transactions. So essentially, activity tripled in 2010 versus 2009. We think there's a significant amount of notes that will be traded this year, probably an equal amount, about $6 to $7 billion more. And they're trading. You asked what they're trading for. We always look at what notes sell for relative to the value of the collateral, not what they sell for relative to par. There have been some cases, we were talking before, that notes have been sold at or above par value. But the remarkable thing about note transactions is that notes are being sold for in excess of 90% of the value of the collateral, in some cases 95 or 100% of collateral value, which is difficult to understand because the best a lender can hope for if they go through the foreclosure process and then resell the asset is 94 cents on the dollar, because they're paying a 3% transfer tax on the way in and a 3% transfer tax on the way out. So it's really been amazing, the demand that exists for notes. And I think when we bring a distressed note to the market, and about 40% of our business was note sale transactions last year, we get 50 or 60 bids on the notes that we sell that are collateralized by New York City-based properties. If we brought out a discretionary seller's property, even if it was the same property, maybe we're going to get 30 or 40 bids. So there's actually more interest in the distressed properties than there are in non-distressed.
Alan, do you see a lot of the European people who are coming to you looking for distressed debt?
They came looking, but I don't think they conquered. A lot of people say they want to buy notes, but it's unless you're prepared for up to a 2 or 3 year battle in New York and Kings County. I think it takes 23 months to prosecute a foreclosure, and then at the end someone could declare bankruptcy. So there's really, note buyers are sophisticated buyers. They're check writers. A lot of these, you have to have the ability to write the check. I understand some debt purchases were financed, but most of them are from very well capitalized people that can cut the check. So as much as everyone wanted to buy this distress and raised a lot of funds to buy distressed notes, as Bob said, a lot of note sales have occurred more and more. But I didn't see too many foreign entities coming in by, although we happened to be involved in a note sale on an Upper East Side project where we got the out-of-town lender, above par for that note, and that was pretty interesting because this person is actually foreign-based, and they are prepared, for the 2.5-year battle based on.
David,
It's such a bizarre environment because when you go back to the late 80s and 90s when there were these workouts, people bought.
You were around at that time?
I was
You were
around.
a kid.
I was trained at the feet of the master,
Okay.
Francis Greenberger at Time Equities. But in those days, you could buy paper for 15, 20, 30 cents on the dollar. So these 90, 94 or at par things make no sense to me. What we've been doing is we've been going to some of these note buyers where they have a vacant or partially vacant property and says, we have a school, we have a university, we have a user, we'll team up with you. You buy the note, you develop the site, we'll buy the base of the building. And that's been one of our strategies at Cassidy Turley. The other thing you mentioned, interest rates, and I just wanted to say there's a specific problem that's been going on for 2 or 3 years. The hospitals and the schools all had tax-exempt bond financing for years. That's been stuck for over 2 years in Albany on a political dispute between the labor unions and the legislature. Hopefully under Governor Cuomo now that'll open up as they start to make progress. So there's been no bond financing for over 2 years on
if you don't
billions
have
of
bond
projects.
financing, you can't build nonprofits.
Pretty much.
So what about the boroughs? Since we will omit Woody from here
Right.
because he's not allowed to talk about that. What do you see happening? Alan, you've sold land in the Bronx. You've sold property in the boroughs. How do you see the boroughs?
It's difficult. It's difficult. A lot of the property that we sold in the Bronx was to low-income developers, part of the 421A tax abatement program that unfortunately has gone away. And when it comes to the cost of doing business in New York City, it is difficult. High barriers to entry, and that was an important program that just we're going to have to rectify it and find something else.
So you see prices have dropped in the boroughs?
I don't see that much activity actually in the boroughs. Yes, for certain retail corridors in the Bronx and in Brooklyn, but I like to focus on Manhattan. Manhattan is an anomaly like Washington D.C. and San Francisco. You got to separate it from
But
the
I
whole
have viewers
equation.
from around the world and also in the other boroughs.
But we're analyzing a lot of sites. Whether we're looking at a 400,000-foot site on the Brooklyn waterfront, a lot of this stuff is speculative. You know what the developer owes the bank. You know the intrinsic value of the land, but it's not just about acquiring the land. You need to be a man with a plan. It's not just buying the land. You got to, where's the debt and construction financing that Woody alluded to before? Where's that coming from? It's starting to open up for the really well capitalized sponsors that put a lot of equity in. It's no problem. You have
David?
banks.
Here's who's buying in the boroughs. Immigrants are buying small properties. And there are barriers to entry even in the communication and the language barriers. So a lot of them have formed their own little business niches. But the main buyers are the affordable housing people. There are a couple of experts who are putting those deals together, and they basically make their living making development fees. And the other big buyer, and we represent them, Cassidy Turley represents them in Queens, is the New York City School Construction Authority. They need 10,000 seats in Queens alone. And so we're busy finding sites where they can build anywhere from a 60 to 100,000 foot public school. Very challenging, and we're in Elmhurst and Jackson Heights and neighborhoods like
Isn't
that.
it true that in New York, in Manhattan, so Woody is allowed for this portion?
He goes to Queens to go to the airport.
Okay, so in Manhattan, there was the situation where Albanese put up Matona and Albanese put up a building where there was a school built into it.
Right. Well, they made a smart deal because it was a two-part deal where the school was
Which
at
is
the
what
base.
happened in the early 90s in many
Right.
of the buildings over there. Bobby, you was talking about Queens before, that the sales volume is down.
Well, volumes are still down in the boroughs, and value is still sliding in the boroughs. We've started to see that shift in Manhattan, and that's a natural thing to see. Manhattan is always the borough that leads us out of downturns, so it's very natural to see that Manhattan will lead the way, and I'm sure the boroughs will follow closely behind. But we're still seeing some fairly significant value reductions in the boroughs. In 2010 we did.
What you were talking before about you did an office deal last year. Talk about that and what you see in the office market today. especially with the prices going up from 4 New York Plaza at $97 a square foot to close the year at 660 Madison at $1,100 a foot.
Do you want me to focus on the office buildings we handled in Manhattan or the boroughs?
Manhattan.
We actually did handle a very large site in Queens West, so we actually do occasionally go to the boroughs. I think the office market in Manhattan is remarkably astounding. If you measure what's happened in the last 18 months, when the office condo at 1540 Broadway was bought for $400 a foot, and a half interest was sold later for near $600, and that's a modern building, so if you take $400 as the bottom, and the example that you mentioned, 660 Madison, some view that as a $1,200 a foot deal. So that's a remarkable recovery. If you look at what Boston Properties will be in for based on what they paid for 510 Madison,
yes.
Considered one of the finest buildings in the city, that's easily $1,000 a foot, and that was the beginning of last summer. So, the high water mark between the GM building and 450 Park Avenue on the southwest corner of 57th was $1,500 a foot. So we have come back from modern product from $400 to $1,200 in the last 18 to 24 months. That is a robust recovery.
And what about B buildings, B office buildings?
B buildings are trading extremely well. In addition to that, we sold 3 of them that closed in December, and all 3 sold at cap rates in the 3s.
And what type of price per foot?
They were all in the 300s.
So they were all over there, but B buildings rents are not going to be at a 510 Madison Avenue rent.
No question.
That's why they're only $300 a foot, because the rents there might be 30, 35
But the biggest
bucks.
problem that we have when people buy is, the real estate taxes continue to go up. And as Alan brought up before, we don't have the 421As, we don't have the tax abatements. We don't have 421Gs.
That's one of the biggest problems the industry is facing right now, is that you've had a significant reduction in value from the peak of the market in 2007 through today, but yet every year real estate tax assessments have continued to climb. So politicians may try to hide behind saying that real estate taxes haven't gone up because the tax rate has stayed flat, but yet assessments continue to go up in a market where value has dropped, and that's not good for the market.
To have the 4 of you in a half an hour is totally, totally inappropriate. So I promise to invite you back later in the season. I'd like to thank my friend Woody Heller, a.k.a. the man who never leaves Manhattan except for Queens West, David Lebenstein, Alan Miller, and Robert Knakal. See you next week.
Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knakal Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Sterling & Sterling, Urban American, The Wickoff Group.